Hi class, and welcome to the first video of Units 3 and 4 Accounting, which is going to run through the role of accounting. I hope that by the end of this video that you understand a number of things, and we'll go through these in the learning intentions in a second, but namely really understanding the role of accounting, the elements of accounting, and the rules of accounting, which we call the accounting assumptions and the qualitative characteristics. For many of you that have done Year 11 accounting, most of this will be revision, but it is a great way to start your journey of Units 3 and 4 accounting. So what are our learning intentions and success criteria from this video? By the end of this video, I hope that you can identify and define the qualitative characteristics and accounting assumptions, identify and define the accounting elements, and you might be able to start to be getting to the point that you can apply these characteristics and assumptions and rules to transactions and situations in business. And that's the purpose of this video. And if you do textbook exercises along with this video, you will achieve the success criteria, namely that you can define these rules, you can apply them, and you can also define the accounting elements and apply them to situations. This is a great grounding in accounting, which will then allow you to start to make reports like balance sheets and start to analyze transactions and really start to think about businesses and how we can improve them as accountants. So before that, let's do a quick do now. This might be the first video you watch for Year 12 accounting, so let's have a think. Can you name the 5 accounting elements that you learnt in Year 11? Can you even remember what an accounting element is? Now, if you're new to accounting, don't worry and move on, but if you aren't, pause the video and try and remember. We will come back to that, but before we do that, I also want you to think about 3 questions which are always going to come up in accounting. Why did you pick accounting? Who are the users of accounting information? And what is ethics and why is it important? We'll come back to these questions throughout these series of videos, but as accountants, we always need to be thinking especially who are the users of the accounting information, because we need to make our information, our reports, our information useful for these users, because these are our decision makers. We need to be acting ethically to make sure that this information will help them make ethical decisions. And hopefully, if we are doing this, we'll start to come to this answer: why am I picking accounting? Why is it important? Namely, because I think it allows us to be a powerful person at a table to guide businesses, make good decisions, to improve businesses, grow businesses, and also make these ethical decisions so important parts of our community grow and thrive and make us all, hopefully, yes, richer, but also better. So now let's come to our elements. Hopefully you came up with the 5 accounting elements, which are assets, liabilities, owner's equity, revenue, and expenses. These are the 5 categories of accounting, categories, foundations of reports, the categories that we place different aspects of business into. Hopefully, if you've done Year 11 accounting, you can think of some examples that fit into assets, liabilities, and so on. And you might even remember this thing called the accounting equation down the bottom. But now, let's go through what I mean by these 5 accounting elements. Firstly, we come to our assets. This is our technical definition, and this is the definition that you're going to use because we're in Year 12 accounting, and it's important to get your definitions correct. And there are some key elements here. An asset is an economic resource controlled by an entity, controlled by the business. I'm going to highlight the important parts. So this is a resource that's got some sort of economic value that's controlled by the business. They control it as a result of a past event. A past event has led to the business controlling the resource. And this resource is an asset because it has the potential to produce future economic benefits. So when we start to think about different items that are assets, and you might be thinking some already, we tick it off as an asset because it is something that is a resource that the business controls that has the potential to produce a benefit to the business. So assets are good. We then come to liabilities. You might be thinking of assets as something that we own, liabilities are something that we owe. Now, we have more technical definitions that we're going to use, but that might be a good way to remember it. Liabilities are present obligations owed by an entity. So presently, the business has an obligation to do something. And what do they have an obligation to do? Transfer economic resources, and this has happened as a result of a past event. So a liability is something that we owe, an obligation to transfer economic resources, and it's happened as a result of a past event. Again, we'll go through some examples in a second. Now, if we look at that, you might be thinking assets good, liabilities bad. That's very simplistic, but that's okay to be thinking of that potentially at the moment because it helps us with our understanding of owner's equity. Owner's equity is how much the business is worth to the business owner. Equity being worth, owner being owner. How much is it worth to the owner? Now, we work this out by the residual value of the assets of an entity after all its liabilities have been deducted. What does that basically mean? The business's worth to the owner is all your assets minus your liabilities. Two other elements that are important are revenues, and these are good things. We would think of them as good things that involve an increase in an asset that results in an increase in owner's equity. So something has increased our assets that has increased our owner's equity, so how much our business is worth, other than capital contributions. So for example, sales increase our assets, but also increase our business worth. Revenues are the opposite. We think of these as, I guess, bad things in a simplistic way, although we need these things to make money. We need to have expenses to make revenue. And these expenses are decreases in assets that result in a decrease in owner's equity. So we will come to these all the way through accounting, but these are our 5 accounting elements. And just to reinforce, here is a little bit more information. We know that assets are expected to produce a benefit. What types of assets might we see? Cash, inventory. So cash, inventory, something that we're going to sell. And then non-current assets like computers, vehicles, buildings, and all our sales on credit, which you might remember are called accounts receivable. Liabilities are obligations, and these are often loans, so loans from the bank or other people, and also if we buy inventory on credit, because we have an obligation to pay our suppliers at a later date. Revenues are inflows. This is often, for example, sales. If we sell a dress for $300, it is revenue. And expenses are the loss of resources, and this might include all the things that involved in a business to sell that dress, such as wages, rent, and also the fact that this dress might have cost us something to purchase. Maybe it cost us $200 to buy ourselves. So that's a helicopter view, a quick explanation of the elements. We will become an expert at these by the end of Year 12 accounting, and we will know lots of different items that go within these elements, and we've introduced a few here. And this is important because, as I said, they are the building blocks of accounting, And this is because these are the key aspects of the most important equation in accounting, the accounting equation. Can you remember what I'm talking about when I say the accounting equation? Hopefully you remember it as assets equals our liabilities plus owner's equity. And we can rearrange it to be owner's equity equals assets minus liabilities. Our business worth is our assets minus liabilities. Or our liabilities equal our assets minus owner's equity. What do you notice here? These numbers must equal. So once you've done some transactions, some reporting, some recording, and you're about to do the analysis, you'll always look and go, have I done some accounting that results in my accounting equation balancing? And we'll come to this again in our next video on balance sheets. The balance sheet is our accounting equation report, and as the term says, it must balance. Now, before we come to the rules, we also know, hopefully, or can remember, that our assets and liabilities get classified. And we classify these as either current or non-current. And hopefully you're thinking hard and going, what does this mean? It means we split it up depending on a certain time period. If we look at our assets, we call an asset a current asset if this asset is expected to provide its benefit within the next 12 months. What that basically means is this asset going to be turned into a benefit? The major benefit is cash within 12 months. Items that you would see under current assets would be cash, your inventory, you're going to sell what you're trying to sell within 12 months, and your accounts receivable. Customers who have been provided goods or services on credit who need to pay us back, we would expect they pay us back within 12 months. Now, by the end of Unit 3 and 4 accounting, you'll know many other current assets as well, but that's the simple premise. Non-current assets are assets that we're not going to get their benefit for within the 12 months because we're going to have it for more than the 12 months. So these are economic resources acquired for the purpose of generating revenue over a period greater than 12 months. These assets we're going to have for more than 12 months, and these will often include things like vehicles, computers, shop fittings, and your equipment. So these are the assets that are often bigger, sometimes quite expensive, and we hold them for quite a long time. Your liabilities, we also split up between current and non-current. And we look at them whether they are going to be settled or paid off. So is the obligation required to be settled within 12 months or more than 12 months? If it is going to be paid within 12 months, we call it a current liability. This might be your bank overdrafts and any loan repayments due within 12 months, and your accounts payable, suppliers who have provided us goods on credit. Non-current liabilities are any obligations that we have more than 12 months to pay off. This will likely include all of our long-term loans. So we're also going to have to be thinking, are our assets and liabilities going to be paid off within 12 months or turned into cash within 12 months? And then we will classify them as current and non-current. And then we come to the rules of accounting. And this is getting a relatively long video, so let's go through these relatively quickly. We have two types of rules. The first rules are accounting assumptions. These 4 assumptions guide all of our reports. They're based on accounting practices and procedures that are accepted by all accountants. And we do this because we want these reports to be completed in a similar way across all businesses. Now, why do we want all of our reports to be completed in a similar way in every business? Good question. It's because we want the ability for us to look at information from different businesses and for it to make sense and for us to be able to compare it, as this helps all of the decision makers and users of accounting reports. Now, our 4 assumptions are these 4. We have the period assumption, and this is the requirement or the assumption that the life of the business is divided into periods. So there is an assumption that we are going to divide our reports into reporting periods, monthly reports, quarterly reports, yearly reports. And we do this because this allows us to report and measure performance similarly across lots of businesses. We have the going concern assumption, and this is the assumption that the business will operate forever and will not be wound up or become bankrupt. Because if we are concerned that our business is going to go bankrupt, it's going to be hard for us to make reports that talk about assets being held for a long time. Thirdly, we have the entity assumption, and this is the assumption or the requirement that the records of the business are kept separate from the owner. We must treat the business separate from the entity and the owner, because we must think of the business as a separate entity, because this allows us to compare businesses as just looking at the business. We don't care how rich or poor the business owner is, and we record things coming in and out of our business because as capital and drawings to ensure that we meet this entity assumption. The final one, and probably the most common one you're going to see over the year, is accrual accounting assumption. This is the requirement that profit, revenue minus expenses, is calculated as revenue earned less expenses incurred. So we need to find all the revenues that we've earned in a period and all the expenses that we've incurred to calculate our profit. Now you're going, I don't understand this, potentially. That's a lot of technical definitions. How do I remember this? The short answer is we will come back to these throughout the year. But there is an easy acronym to help us. When you see the word accounting assumptions, I want you to think of the acronym PAGE, because we are looking for the P in the period assumption, the A in accrual basis, the G in going concern, and E in entity. Now we will come to these assumptions throughout the year and we'll become an expert, often looking to think about why are we doing this method of accounting, and often we are doing it to make sure we meet these rules or accounting assumptions. Now these are just some of the rules. We also have qualitative characteristics. Qualitative characteristics, of which there are 6, relate to the quality of the report rather than the figures. We're looking at how focused and what is the quality of the report. We would say that if you do all of these 6 qualitative characteristics of your reports, you're going to make focused and quality reports. And the 6 are here. We would expect our reports to meet the characteristic of timeliness, because information is only valuable if it is provided in a timely manner. If I'm in 2020 now or 2021, it's no point that if the information is not useful if I'm still relying on 2018 financial reports. I want to be looking at the most timely, recent information when making my decisions. When I'm looking at this timely information, I want to make sure that it is meeting the faithful representation characteristic. This means that the information must faithfully represent, so accurately represent, the events that have occurred. I then want this information to meet the understandability characteristic. The information must be presented in a way that a person with a reasonable knowledge of business can understand it. There is no point us making reports that are so complicated that reasonable people can't understand it, because they are the people we want to be making good decisions. We want to meet the comparability qualitative characteristic, and this means that as we make reports over different years and reporting periods, we should apply consistent accounting methods. We should be able to pick up different year reports and they will have different numbers, but we must be confident that these numbers have come from a consistent accounting method. We can't chop and change how we're doing our reports. We need all the information in our reports to meet the relevance characteristic. This means that information should be in the reports if it has the potential to affect the decision making. So we should not include information that won't impact decision making. So that might be why we don't include, for example, the specific information about what we're trying to sell. But if it has the potential to affect decision making, it should be in our reports. And everything in our reports should meet the verifiability characteristic. All the information should be presented accurately, and all the numbers, all the information should be supported by evidence. We can't just make it up. And this evidence comes from source documents, which will be our third video. How do we remember this? Using again another acronym, CVTURF. C for comparability, V for verifiability, T for timeliness, U for understandability, R for relevance, and F for faithful representation. Now you're going to have lots of theory questions to answer potentially, especially at the start of accounting, as we start to master the understanding of the elements and these rules. How will you answer these questions? Number one, read the question carefully. So important in units 3 and 4 accounting. So important. Read the question. Identify what's they're asking you to do. What is the business that we need to talk about? And what specifically has happened? Then you're going to hopefully, to answer a question well and get full marks, tick off 3 elements. And we call this the identify, describe, link method. For example, if you've got a question asking you to talk about a qualitative characteristic, the first thing you're going to have to do is identify the characteristic that is relevant. You will then have to describe, or you might even define, describe or define are quite similar, that qualitative characteristic. So for example, the faithful representation characteristic is relevant in this theory question. Faithful representation means that we must accurately represent what has happened in the business. Now that is all great, but you will be very hard to do a good theory question unless you link it to the case study or the question that we've asked. Hence, you must read the question carefully. So then you might go, this is relevant in the business Tim's Fish and Chips because they must faithfully represent that some of the fish has gone off and that hence we have reduced the value of our inventory, for example. So hopefully you have left this video being excited for Unit 3 and 4 accounting, and you go on the way to the process of understanding the qualitative characteristics and accounting assumptions. I should say assumptions there, I apologize. You can identify and define the accounting elements, and you're on the way to understanding using the identify, describe, and link method how you can apply your characteristics, assumptions, and elements to theory questions. A lot of information in this video, a relatively long video. Now's the time to practice and start to become a master of these rules, which we will be consistently applying throughout our journey of Unit 3 and 4 accounting. So what's next? In our next class, in our next video, we'll be looking at balance sheets where we apply these accounting elements to make sure that to report the financial information of a business while making sure we meet the requirements of these rules and ensuring that our accounting equation balances.